Hey, Open Trades! I wanted to do a video analysis update on some ETFs that I bought recently, some pretty controversial ETFs that I bought recently, and I bought them before their first ex-dividend date, which I believe is October 2nd. They made their announcement on September 29th. These ETFs are pretty controversial. I'm referring to QQQY and JEPY. No, not JEPY, a different JEPY that sells 0 DTE put options on the S&P 500 and for QQQY for the NASDAQ 100. So these are selling cash secured puts in fully collateralized counts, cash settled options on the S&P. Very, a lot of people have a lot of thoughts about this. I've got some thoughts about this. This is probably the most controversial topic I've ever covered on this channel, just to be obvious. So this is absolutely not investment advice. These ETFs are brand new. They've been around for 2 or 3 weeks, right? So and they're selling puts on the S&P and the NASDAQ. And whenever selling options is involved, most people's ears immediately perk up, think that's super, super, super risky. We'll get into the risk of that. Those risks should not be understated. But anyway, the summary for QQQY. What is this ETF doing? Why are people so hyped up about this ETF and passionate and, or even angry about it? They think this is going to crash the market. QQQY, the first put right ETF using daily options to seek enhanced income for investors paid monthly. Wow. QQQY aims to achieve consistent and outsized monthly yield distributions for investors coupled with equity market exposure to the NASDAQ 100. QQQY is an actively managed ETF that seeks enhanced income constructed of treasuries and NASDAQ 100 index options. The strategy's objective is to generate outsized monthly distributions by selling option premium on a daily basis. The fund uses daily options to realize rapid time decay by selling in-the-money puts with 0 DTE. Wow. There's a lot of puts being sold every day. 2 puts are going to be sold. One's going to be at the money. One's going to be up to 5% in the money on QQQ. That would cost me, if I wanted to do that, if I wanted to go sell, open, in a brokerage account, enable options trading and go sell 2 puts on QQQ, that would cost me over $71,000 in collateral that I would have to have cash secured puts be sold on QQQ to sell 2 of them. They wouldn't be cash settled options, most likely. And that's a lot more than $20, which is the current price of these ETFs. So their top holdings, almost all cash and T-bills, 70% cash, 16%, a T-bill for the end of the year, 14% a T-bill for November of next year. Pretty short term. And then every day they update the puts that are being sold, right? So you can see this massive amount of collateral that they have. $22 million, dollars in cash. That's one reason they're able to do this. Not to mention, it looks like they've got about $10,000 in treasuries, about $10 million in T-bills. So they've got about $30 million sitting on the side, if I'm reading that right, in collateral. So that's how they're able to do this. Cash secured puts. We'll get into this strategy, but I do love that I can always just see, what they're doing, and I can always be reminded I could never do this in a brokerage account. And even if I did have swaths of money, it wouldn't make sense for me to sell the options just directly. It would make more sense for me to have an ETF do this, right? Everyone looks at the yield max ETFs and they say, oh, but I could run the synthetic covered call on Tesla myself. Why would I pay yield max to do it? And it's like, okay, yield max is using European style flex options, cash settled, all types of stuff. They've got collateral, they've got professionals doing it. Even if I had all the money in the world and all the time in the world to run synthetic covered calls on Nvidia and Tesla and the covered call on KWeb and sell puts like Put W sells puts and do credit spreads on treasuries like sells HIGH. It wouldn't make sense. It wouldn't be a good use of my time. It wouldn't be a good use of my money for me to, just do all that myself when an ETF is going to do it, for $20. QQQY, first distribution announcement. This popped a lot of eyeballs. It's they announced a 67% distribution. Now, what was crazy was that JEPY, and I'm really just going to focus on QQQY because it's been around longer. JEPY also, but I did buy JEPY too. I hate that it's got the same name as JEPY. But anyway, they announced that distribution too. It was also pretty high. So I bought both of them. Not just because of that distribution. I was looking at these for a while, but when I saw, this was legit, or at least it seems legit, I was, they sold the puts and then, they're about to hand them out to their shareholders, right? Very interesting. 67% distribution. So we're going to talk about why this could be kind of crazy, right? 67% yield. This ETF's only $19, $20. It's already paying back $1.10. And it's selling. This is kind of crazy because the 60. We'll talk about some possibilities, right? This is what they, this is the trap, right? They get the retail investors like me, all excited about these ETFs with the yield. I mean, I've heard it all. We'll get into the risk of it. But what's so crazy about this? Well, this is a 67% distribution. And remember, if you're new to this, channel, I don't ever just buy the buy right funds themselves. What I like to do is I like to take a fund like Tesla and I like to blend it with Tesla. I like to take a fund like Clip, which sells covered calls on KWeb, and I like to actually blend it with KWeb so that I'm not, at least some of that allocation is not being covered by the options that are being sold. So they're going to fully participate in upside is another way of saying that. And so that's really important to me, and that's one thing that I really like about ETFs like QYLG, which is Global X's half right on the Nasdaq 100. So they instead of what QYLD does, which is they sell at the money covered calls on QQQ each month, and so they're fully covering the Nasdaq 100, right? So the Nasdaq blows past that strike price, they're not going to participate in gains. QYLG is only covering half of its holdings, right? So that's called the half right. That's my preferred income method. So I never just buy Clip or Tesla. I accumulate those, initially. But if I have an opportunity on a dip, I'll buy the actual shares that aren't covered. I did that with Coinbase and Coney. But let's just think about some of those ETFs I'm saying. KWeb, right? Chinese internet, pretty risky. Tesla, Nvidia. ARK, pretty, risky individual names, right? Tesla, Nvidia, ARK, Netflix, I mean, there's stability there, but at the same time, they're individual stocks, right? And the ones that are ETFs are ARK and they're KWeb. And so those ETFs, the reason that they have these high yields, right, these really high forward distributions can be seen right here. The reason they have these really high distributions is because they're running the buy right on very volatile, risky assets, right? They're selling insurance, right? Options is all about selling insurance. It's all just an insurance contract, right? So they're selling insurance essentially to 22-year-olds with a DUI, if that kind of makes sense. Right, so that's how they're getting this premium, is that they're selling risky insurance, right? Does that make sense? They're selling car insurance to Coinbase, right? If that makes sense, Coinbase is very risky. So they're going to get a really high premium, but for me to collect that premium, I have to have exposure to Coinbase. I have to have exposure to Tesla and Chinese internet, right? And so that's why I have to hedge the downside with ETF, with, various methods of, hedging directly to the downside. I own put options on the Metaverse ETF that I've gone over before. They're called long gamma positions, but they're biased to the downside. And so I have really deep in the money puts on the Metaverse ETF. So that's why I'm able to collect premium from Tesla, Nvidia, ARK, all this kind of risky growth. Because if, that sector goes to, gets obliterated, then I need that insurance that I own, right? Because ARK and Tesla and KWeb are a lot riskier than QQQ. And they're definitely a lot riskier than SPY. They're definitely a lot riskier than SPY, right? So the reason that I'm talking less about JEPY in this video is because it's only been around for about a week or so. And so I'm hesitant to really make much of any of the data that comes from JEPY, even though that ETF seems like it's too good to be true. But I think that JEPY, if it kind of continues its success, I'm actually more interested in that than QQQY, because that could potentially give me a huge yield. But instead of it being on an ETF that's predominantly, Apple and Microsoft, right? And the S&P's got a large holding of Apple and Microsoft, and a lot of the Nasdaq's tech friends. The S&P, is a lot more diversified than any of these other high yielding, high growth options. That doesn't mean I'm getting rid of them. I'm still going to hold them. I still like them. I'm still going to keep reinvesting the dividends even. But this is, even the idea that this ETF could be selling a lot more, could be yielding higher than SVOL is pretty crazy, because I've, basically made it clear how much I love, SVOL on this channel, why I invest in it. And this is also kind of doing a similar thing JEPY could, getting a substantial amount of premium from, an underlying that's the S&P 500, right? So what I am thinking about, what I'm actually doing, honestly, is I am blending QQQY with JEPQ. So I made a video about JEPQ recently, but JEPQ essentially, the way I understand JEPQ, and this could be incorrect, is that it's about 80% just long the NASDAQ, but it's actively managed, so it doesn't have to own the NASDAQ directly. It can pick and choose the funds in the NASDAQ and even funds outside the NASDAQ that it wants to own, right? So it mostly tracks the NASDAQ, but it's not going to perfectly track the NASDAQ. The other 20% of JEPQ uses equity-linked notes to essentially get a lot of covered call premium. Equity-linked notes, this probably isn't the video to go into a seminar on equity-linked notes. I'm probably not the person, to do it anyway. But that's essentially a fund within a fund within a fund. It's like fund inception. And so that JEPQ has, a 20% allocation to equity-linked notes, which is essentially a covered call fund within, JEPQ. And then the other 80% of JEPQ is just long the NASDAQ, is the way I, am interpreting it. So if JEPQ is about 80% essentially long QQQ, then roughly a 63% allocation to JEPQ and a 37% allocation to QQQY is going to get me something similar to the exposure of QYLG. So QYLG I talked about, recently. It's an ETF that runs the half right on the NASDAQ. It gets half the exposure of the NASDAQ's upside, and the other half is collecting covered call premium, right? Kind of the best of both worlds. Here's the problem. QYLG only yields about 6.2%. I think I've got this. Yeah, so this is really the slide that I wanted to talk about with JEPQ and QYLG. So what my kind of idea is, first off, just to be clear, this QQQY is not going to track the NASDAQ directly. I'm going to get more into that later. But just taking that, into consideration, I'm going to consider QQQY is going to be a very kind of covered call like position. It's not going to, I'm not betting on it tracking the NASDAQ at all. I'll get into how I think it's going to track the NASDAQ in a little bit. What my idea for me and what I'm doing is to blend about 63% JEPQ with about 30% QQQY. The goal is that if JEPQ is running it's holding 80% of the NASDAQ directly, then this allocation is going to give me about 50% of the NASDAQ and 50% funds that are collecting a lot of premium from the NASDAQ. So, if QQQY is yielding 60 to 65%, right, which would have a big asterisk by it because it's the first month and it was a, volatile September where the VIX spiked like they always are. If that's QQQY's, yield for that portion, and I'm blending it with JEPQ for the other 63%, JEPQ's yields about 11 to 12%. I could potentially be looking at a yield over 30%, getting half the exposure of the NASDAQ, right? My goal is to have kind of the same upside exposure as QYLG, right? Half the exposure of the NASDAQ, and then the other portion of the fund is going to be, collecting option premium. So QYLG, what I'm saying is I think that this could be a much better option for me than QYLG, because QYLG's current dividend yield is 6.28%. Now it's pretty high, but in this high yield environment, there's an ETF that has cash. It's a cash alternative called CSHI. CSHI has a, because of these high, interest rates we've got right now, CSHI is actually holding cash and yielding higher than this, than QYLG, right? So I think that, for me, 63% JEPQ and about 37% QQQY is going to get me the exposure of QYLG, but with a much higher dividend. Instead of 6.28%, I think it could be over 30%. I wanted to get into a little bit of how I wanted to read kind of directly from the prospectus for how this might track the fund. So this portion of QQQY is not fully going to track QQQ. So I'm going to read this sample from the summary prospectus down here. So for example, on a particular day, the fund QQQY were to sell 1% in the money put options having a 1-day term. The fund's participation in the positive price return of the index will be capped at 1% that day. So if they sell a 1%, if the put is 1% in the money, then their participation for that single day for QQQ is 1%, okay? However, over a longer period, i.e. a 5-day period, the fund should not be expected to participate fully in the first 5%, 5 days times 1%, of the positive price returns of the index. Or the fund may even lose money even if the index share price has appreciated by at least that much over such period, if during any particular day or days over that period, the index has a return less than 1%. This example illustrates that both the fund's participation in the positive price returns of the index and its returns will depend not only on the price of the index, but also the path that that index takes over time. So that's an important thing to understand. If they're selling a 3% in the money put, then for their participation for that put, they can go up to 3% on a particular day. This example that they gave is a 1% in the money. Their prospectus says it can be up to 5% in the money put that they sell, and then they'll also sell an at the money put. So for the in the money put, they will be able to, on a daily basis, the way I understand it is that they're going to be able to participate in QQQ's price participation up to the strike price of the in the money put. Okay, so in this example, QQQ has to go over 1% and really close over 1% for it to have been better on that single day to hold QQQ instead of QQQY, right? So let's talk about, I think one reason I wanted to make this video today is because yesterday was a perfect example, and really we have so many of these days all the time where they're just chop days. I mean, really the whole third quarter was a chop quarter. We went sideways for the whole quarter basically, right? So, but we have choppy days, choppy periods all the time. in wave theorists don't say, hey, we had a base breakout, the stock's going to go to the moon forever. Wave theorists are always anticipating corrective waves along the way, right? For, if I'm anticipating, my video I made, yesterday, I'm anticipating a shallow wave 4 to end in the S&P 500. We're going to take another wave 5 higher, right? And so if, before, if I was anticipating a wave 4 correction and then a wave 5 higher to be bought, well, JEPY might have been the perfect ETF for that, right? Let's say, my outlook for Elliott Wave was that we were going to go higher for wave 3, retrace for wave 4, and then higher again for wave 5. But the wave 4 correction was going to be a long triangle, right? It was going to be a long choppy period. Well, JEPY might be the perfect ETF for that because it's going to, go up slightly a little bit, but I'm expecting a long choppy period. And the point is, I don't have a way, and retail investors don't really have a way to profit from choppy sideways periods or choppy sideways days, really, there's no good way to do it. There's not really a good way for retail traders to profit from choppy periods, besides collecting covered call premium and cash secured put premium. And those require a lot of collateral. Now there's a lot of ETFs that, provide that collateral within the blanket of the ETF. So that's why, I'm interested in these. Again, I always blend the covered call fund, the option selling fund, with a fund that is not being covered. A good example would be blending TLT, the Treasury Bond ETF, with TLTW, running the buy rights on the Treasury Bond ETF. Or, because of the rate environment now, it's been a little better to do that with, HYG and HYGW. Okay, anyway, let's get back into Let's get back into QQQY. I think I've made it pretty clear that this isn't going to fully track the NASDAQ. I'm not betting on it fully tracking the NASDAQ. Let's talk about some pros. Access to selling 2 0-date till expiration puts each day on the NASDAQ. Each day, the fund will sell at the money and in the money puts on the index or a passively managed ETF that seeks to track the index's performance. In particular, the fund will sell puts with near-term expirations at a range of 0 to 5% in the money. So the closer, this is a huge thing about options and Greeks, theta decay gets exponentially more rampant as the expiration date approaches. That's the most important thing to understand about options, is that gamma and theta, so gamma is the explosiveness of the option, how much that option can move. Right? How much can that option move? That's measured by gamma. Gamma is the rate of change of an option's delta. Okay. Theta is the time decay of an option. So for me, the best time to buy a leap put or a leap call is when implied volatility rank is, 0%. And then the best options for me to buy, if I'm hedging, for example, with an ETF like METV, are going to be the furthest expirations. I don't do like over a year, right? But the further expirations, METV doesn't have expirations over a year, right? So I do the furthest expirations because those options decay the least. And the fact that METV is a $10 ETF also really helps the decay be lower. The fact that the options are in the money, also helps. Anyway, further dated options have a much slower rate of time decay. As the expiration date approaches, time decay doesn't just speed up, it exponentially speeds up to the point where a 0DTE option is a very low odd overtime buy. It's a really bad idea to buy 0DTE calls and puts because the time decay is so rampant at that point, especially on an ETF like QQQ or SPY, that's way up in the hundreds, that's going to have a ton of time decay. And yes, the gurus are going to post their winners where it goes up 400%, but most of the time, if the market's just flat I mean, how often does the market dip for the first 30 minutes and then recover? A red to green day, a green to red day. You know, this day we just had on Friday was a perfect example. Market goes up 1% or so or less and basically retraces the whole thing and closes basically flat. The perfect day to have sold 0 DTE puts on the S&P, and that was really the only winning trade of that day, unless someone was basically gambling. So this is kind of being done every day, for me. The pros, rampant theta decay, choppy days and weeks now become more profitable than ever. In my opinion, buying bloated puts on QQQ and hoping for more downside is a losing strategy. But if I'm expecting that eventually the correction's going to end, then selling these 0 DTE puts and what I've described, owning, 63% JEPQ, 37%, QQQY, collecting all this option premium when the correction's occurring. If my analysis is that eventually the correction's going to end, then that's a great way for me during that long sideways wave 4, during annoyingly long, in wave theory it's called a double correction, an ABC correction that seems to take forever. ETFs that collect all this option premium, and in particular in down periods, selling puts, all that put premium, could be very interesting over time, reinvesting dividends. So before QYLD and JEPQ yielding below 13% were the only way to profit from NASDAQ IV crush, right? So all the people on StockTwits and FinTwit, they're always talking about how the MMs are doing IV crush to screw retail. Theta gang always wins. Well, this ETF is taking advantage of Theta gang. This ETF is joining Theta gang. And then what? All the StockTwits and FinTwit people say, oh no, this is so bad. This is so bad. It's like, all right, well, which is it? Is Theta gang always going to win? And the retail options just go to splat? Well, the statistics is that actually is what happens over time. If a wave theorist expects a double correction or a lengthy wave 4 that often follows a wave 3, this is my preferred way to profit from chop and dips that I expect to be bought, similar to I've talked about what I do with NVIDIA, how it's had that big period. It could digest these gains for a while, but then I think it eventually heads higher. NVIDIA has been collecting huge dividends during this kind of consolidation period. So some thoughts: diversification across the NASDAQ 100. The whole S&P 500 in the case of JEPY is much safer than OARK and CLIP. Because that's ARK and KWEB buy right ETFs. If 80% of JEPQ is in an investment in the NASDAQ 100, a 63% allocation to JEPQ and a 30% allocation to QQQY will give me the same quote-unquote exposure as QYLG, which runs the half-right strategy on QQQ. The only difference is the yield goes from 6.28% to 30%. Concerns: how will QQQY recover after dips? A common concern with QQQY and all premium collecting strategies is the limited upside participation. So, I've talked about JEPQ so much in this video, I won't annoy the people who actually listen. For QQQY, the prospectus says it intends to sell one option that is at the money and one option that is up to 5% in the money. This in the money put will be able to participate in gains experienced by QQQ up to the strike price. For example, for simplicity, assume the index is trading at 100 at the time the fund sells an in-the-money put with a strike price of 105. If the index's level increases to 105 before expiration, the fund would benefit from the increase in the index's value up to 105 through the receipt of the premium, which was earned through the sale of the option. So a lot of people think this can't recover. This is saying that's not really how it works. The put that's being sold that's in the money has intrinsic value, and the fund can participate up to that strike price on a particular day. That is, if the fund sold the put for 0.50, in addition, the fund's gonna benefit slightly from the in the money put's extrinsic value. That is, if the fund sold the put for 0.50% at the time of time value, an amount paid above the put's in the money value for the put's potential to increase in value before expiration. The option in the example would earn up to 105.5. However, if the index increase exceeded 105, the fund would not participate in any additional gains. Further, if the index level drops below 100 at expiration minus an amount equal to the put's time value, the fund would lose money. So if the fund sold the option for 0.50 of time value, the fund would lose money. If the index fell below 99.5, the fund would be obligated to pay the holder of the put option the difference between the strike price and the actual level of the index multiplied by the contract multiplier, usually 100. So thoughts on Greeks, put W. Some other alternatives, rolls short puts bi-weekly on the S&P 500, and most covered call funds target 1 month at the money expirations. Some say the rule of thumb is to sell a covered call with a delta of 30 that expires 30 days out. Yield max sells out of the money, so Yield Max takes advantage of this out of the moneyness, but they're doing it on very risky, underlines. They're trying to, offer more options with an ETF that runs this on ExxonMobil, Disney, and Amazon. All that I'm looking into. Yield Max sells out of the money synthetic covered calls on volatile growth stocks to achieve its high yield. Zomo, DSO, and AMZ may provide stable options, and ARK, KWeb are less safe underlines than QQQ, right? That's kind of the whole point. And then, so that's why it's so crazy that JEPY could really, be one of these ETFs that, is yielding a whopping 40%, a whopping 50%, then a whole lot of, possibilities start to come up. QQQY and JEPY make up for the less risky underlines by selling zero DTE options that rapidly decay. The prospects of adding them to NASDAQ or S&P 500 tracking holdings is enticing. Could calls on PSQ and SH hedge combinations of funds and option selling ETFs like these.